today's video, I will show you an example of a subtle market manipulation in the daily chart of the British pound versus the Australian dollar. I will demonstrate to you how market makers set up a trap for retail traders and how they make the market turn using the retail traders as an axis. In the blue zigzagging lines, we can see an expanding pivot formation, which is characterized in this case by a higher high followed by a lower low. A higher high usually means buyers are in charge, but when followed by a lower low in an expanding pivot, it means that buyers were in charge and then sellers prove their ground against those buyers. The sellers do that by creating a price vector with higher volatility. There is absolutely nothing that stops this market from creating yet another leg for a continuation of the expanding pivot formation. But if we pay close attention to the details of price action, we can anticipate a clear change in behavior between the last leg of the expanding pivot and the price vector that immediately follows it. Just take a look at how different those two price vectors are. The bearish vector appears to be more chaotic and contain more than one flow buried in the candles. The bullish vector after that is rather clean and maybe even suspiciously organized. This idea of organization in the price vector can be identified in this example using two different perspectives. First, look how this bullish vector is the representation of one clear flow, unlike the previous vector that created the expanded pivot formation. The second perspective is to observe how smoothly the highs and lows in the candlestick level are displayed. We have two bullish vectors and one bearish vector that could be interpreted as a small correction in the middle. In all three of those vectors, the highs and lows in the individual candle level progress smoothly. Look how in the bullish vectors, every candle produces a higher high and a higher low, and in the bearish vector in the middle, every candle produces a lower high and a lower low. If you stop to think about this for a moment, you'll realize how unlikely it is for a market involving millions of people trading the British pound and the Australian dollar to display such a noiseless behavior in price. Notice also how the bullish candles in this vector give the impression that price is accelerating to the upside. All of this is not an accident, of course. It's made by design for a very specific reason. The thing is that large traders in the market know that there are hundreds of thousands of retail traders thinking that if price reaches the red horizontal line, which is the highest high at this point, the market will simply skyrocket and create a nice profit for their long positions that are just sitting there waiting to be triggered. What retail traders always fail to realize is that this is perhaps the most obvious trading idea that anyone could ever have. And market makers are fully aware of this, so they will use their power to move price in strategic points to take advantage of the fact that there is a cluster of long retail orders sitting at the red line. The more the last bullish vector gives the impression that the market will skyrocket, the more retail traders jump into the bandwagon of buying the red line. This is called the von Riestorff effect, and you can learn all about it in the Market Maker Strategy video course in the link available in the video description. So let's fast forward price to see what happens in the red line. When price hits the red line, which is where the cluster of long stop retail orders are sitting, something very interesting happens. Large traders need liquidity to execute their large positions, so they need areas where the market has deep liquidity pools, which is the case of this red line due to the retail traders' orders. That's the only way large traders have to sneak in huge positions without causing chaos in the market. The pernicious thing about this is that in order to do that, they need to manipulate huge amounts of retail traders by inducing them to the wrong side of the market. And that's exactly what's happening here. The whole bullish vector before price hit the red line is nothing more than large traders inducing retail traders to think that putting a buy stop order at the red line is going to be a brilliant idea. That created a lot of demand at the red line, and if there is a lot of demand in one area, it means that there can be a lot of supply as well. So market makers will take the opposite position of retail traders at the red line. In other words, when retail traders are buying, large traders are selling. We can see that by the shape of the candle that touches the red line, which is a fractal candle, by the way. When retail traders realized that their idea was not as brilliant as they thought, out of pure desperation, they begin to jump to the other side of the market. This also helps the market makers because now they have hundreds of thousands of people helping to push the large sell orders to the right direction. There are more details in here, but this is roughly how large traders manipulate small traders. The cynical thing about this is that not only the retail traders are hopelessly manipulated, but after they get maneuvered, they help push the large traders' order to the right direction. It's almost like the retail traders have Stockholm syndrome without realizing, of course. If you want to learn everything about how manipulations occur and how you can take advantage of them, check out the Market Maker Strategy video course in the link available in the video description. If you want to support the channel, please click the like button, subscribe to the channel, activate the notifications button, and leave your comment below. Thanks for watching, and I hope to see you in the next videos. Take care.